Warren Buffett just released his annual Berkshire Hathaway letter, and so let's take a look at that and see what we can learn from it. That's what I'm going to cover in this video. So guys, as you smash that like button, let me run that intro. What's up guys, and welcome back to the channel. Now before I got into the letter, I just want to talk about exactly like what these letters mean to me. Now I have this huge binder and I've had it for many years, and every year I just print out the Berkshire Hathaway annual letters, and I'll read it, I'll highlight anything that is very important to me. I learned a lot from these letters when I was really young, not so much in the recent years because Buffett has really like pulled back and he just talks more like a high level, but they're still interesting. You can always still find a little bit of tidbits and nuggets of information in these letters. Now, the first thing that I want to talk about is what exactly does Warren Buffett mean to me? And I think a lot of us can agree that I think the biggest takeaway from what Warren Buffett has preached over the years is that you don't necessarily have to be the smartest person in the world, or in other words, your intellect is not correlated with how well you can do in the market or just in commerce in general. I mean, it definitely helps, it's definitely an advantage, but when it comes to investing, I think he's absolutely right that for an investor it's more about temperament, not about intellect. And so like as a young kid, this actually really gave me hope, because like, can we just be real for a second? I know a lot of you guys think I'm smart, but really I'm just average, and there's nothing wrong with being average. All it means is that you're just like everyone else. Well, if you're average and you grow up going through the modern schooling system, one of the things you're taught right away is that the smartest kids get rewarded. Well, if you grow up that way, you just grow up thinking that, okay, well, you're probably not going to get rewarded in society as a result of you not being as academically as inclined as everyone else. Well, once you start working, once you're in the workforce, you realize that was all bull. And the truth is that the people that focus on capital savings and capital deployment, they generally do get ahead. Now, it's not like the smart people don't get ahead, but effectively there's more than one way to bake the cake here is essentially what I'm trying to say. And that little bit of hope that I got as a young teenager from reading Berkshire Hathaway annual reports translated into a wonderful investment career, just career as a whole, and it's provided me with more sort of like wealth than I'll ever really need. And it's put me on this path of self-actualization, which is sort of like a Maslow hierarchy of needs type of thing. And really what it means is that my purpose, or at least a major part of my purpose in life, is to help you guys and sort of impart everything that I know, even though it's not that much, just impart and make an impact on the world by impacting you guys. And so that's why the purpose of this channel has always been to help at least 1,000 people move closer to their goal of achieving financial freedom as well. And so let's dive into this article a little bit more and see what we can pull out of it. So the first thing that I wanted to point out was just the run that Berkshire has had from 1965 to 2022. Notice how the company has compounded annual gains of 20% compared to the S&P. So that's double. And that overall gain is 3.7 million% versus 24,000. I mean, you would have done well just by investing in the S&P 500, but the fact that the Berkshire Hathaway has just massively outperformed. But the thing that I want to point out is that in most years when the market is up, so look in 2012 and 2013, Berkshire Hathaway is generally up in line with the market. I mean, some years you have a little bit more outperformance, but the idea is that it's generally up in line with the market. But here's where Berkshire Hathaway really outperforms. In many years when the market is down, Berkshire Hathaway outperforms, and you're seeing it less and less in the future years, but you definitely saw it in 2022 where the market was down 18%, but Berkshire was actually up 4%. And if you go back in their history, you'll notice that the real strategy of the Berkshire Hathaway portfolio is that they don't outperform when the market is outperforming, but they definitely outperform when the market is underperforming. So because they just chopped off those lows, the company has been able to do very well. Now, I definitely do not target 20% in my portfolio. I target only 12.5%. And that's something, just an easy step that I can walk over year in and year out. And I think, there's nothing wrong with trying to get rich slow. And so that's why I do target that. Now, I have told you guys that when it comes to cash secured puts and covered calls, I do like to look for minimum 15% yields. The point of that is that it just gives me a little bit of a buffer to achieve the overall goal, which I'm trying to achieve, which is only ever just 12.5%. And some years I do much better than that, some years not so much. And so I love Warren Buffett's humility. So the first area that he starts with is talking about the mistakes that he's made in his career. So he goes on and says, over the years, I've made many mistakes. Consequently, our extensive collection of businesses currently consists of a few enterprises that have truly extraordinary economics, many that enjoy very good economic characteristics, and a large group that are marginal. And I think that's how our portfolios are going to end up as well. And so this is where actually, my strategy of purchasing companies for well under their intrinsic value could result in me losing on some very interesting opportunities. And so this is where I'm going to pull back a little bit from that and just start paying closer to fair price for extremely exceptional opportunities. And I've started to do that already in 2023, and I also did that earlier on in my career as well. And so we'll continue to do that as well. And so the other point that he said was that the efficient markets only really exist in textbooks, and I think we all know that. Just as investors in many of the positions that we end up acquiring, we know that the market's not being efficient, and that's generally what gives us the opportunity to do what we do. Now, the next section of the annual report was probably the most important or interesting part of the annual report, because he starts talking about buybacks as it relates to Berkshire and sort of how society's starting to look at share buybacks right now. And so let's dive into that. So you can see he starts off by saying, at Berkshire, we directly increase your interest in a unique collection of businesses by repurchasing 1.2% of the company's outstanding shares. And he goes on to talk about the math of buybacks, and he basically says that it's not complicated. When the share count goes down, your interest in many of the Berkshire Hathaway businesses goes up, or in all of their businesses goes up. And so every small bit of stock buybacks does help if they're being made at value accretive prices. This is why a lot of people were a little bit upset with Alibaba for not purchasing more shares, because the share price was at such a value accretive price. But it is what it is. And so here's the other thing: when a company overpays for repurchases, the continuing shareholders lose, because the selling shareholders get a much better price for their shares. And so, they're able to sell high. And so, share buybacks, effectively what he's saying, are a double-edged sword. And so you just have to know how to use them appropriately, and, make sure that as a company, when you're buying back shares, you're doing it at a accretive price. But, as investors, one of the things that we have to focus on is really, where's the cash of this business going? So you calculate EPS, or you calculate free cash flow per share. That's all well and good, but then the next question is, you got to go lower on that cash flow statement and ask yourself, what are they doing with that cash? That's in that cash from financing activities space on the cash flow statement. And the question here is, if they're buying back shares every year, are they buying them back at a roughly fair value for the company, or are they buying back overvalued shares? The other thing that I'd want to point out is, take a look at that stock-based compensation line. Are they issuing a ton of stock-based compensation to the point where it's dilutive to the shareholders? And so even if they are buying back shares, are they just taking free cash flow away from us? And so if you go into the Alibaba model, you'll see that Alibaba does have a high stock-based compensation amount. And so I actually value them using a free cash flow per share metric. However, I adjust that free cash flow per share metric from the expected stock-based compensation dilution amount. So I very much charge them for future expected dilution of the shareholders, because that cash flow is really not coming to us. And so, if you do that type of valuation, you're just going to arrive at a lower value for the company, but it's a more correct value from my perspective. And so the big takeaway from here, and I'm not an expert or anything, but what I can impart, if I can impart anything at all to you guys, is that, don't just focus on that EPS or the free cash flow per share line. Focus on where the cash ends up as well. Some businesses, they have to continuously reinvest that cash into the business, and then in other words, the cash essentially just gets burned. Other businesses, they may just have that cash sit on the balance sheet and it just doesn't do anything over the long term. And so, you have to almost adjust your valuation for the fact that they're just not good allocators of capital. And the one that bugs me a lot, and I've been seeing it a lot recently, is a lot of companies have reinvested into a lot of inventory, and that inventory is sitting on the balance sheet right now. And I would suspect that quite a bit of it has to get discounted to be monetized. And so really what that is a discount to the free cash flow that they earned previously. And so, how do you think about revenues going forward with those types of companies? And how do you think about sort of like revenue monetization into real free cash flow going forward? And so those are real questions that you have to ask. These are all company specific questions, but it signals, at least in that scenario, that might not be an optimal business. And so this all starts from going under that free cash flow line, or that free cash flow calculation, and going to see exactly what they're doing with that cash, either in the financing or investing sections of the cash flow. So you got to get very good and versed at understanding how these financial statements work and how they work relative to the company that you're looking at, because every company has specific characteristics that you have to understand. Now, the next section, Buffett actually takes a shot at politicians and how they've been talking about share buybacks recently. So let's take a look at that. So you can see here right at the bottom, when you're told that all repurchases are harmful to shareholders or to the country or particularly beneficial to CEOs, you are listening to either an economic illiterate or a silver-tongued demagogue, characters that are not mutually exclusive. And so that's a really big shot against Biden and Trudeau. And so what exactly is he talking about here? Well, you can see that Biden recently came out and said that he wants to quadruple the stock buyback tax, and the way that they're pushing this is effectively saying that stock buybacks are harmful to society, which makes no sense, because if stock buybacks are harmful, then are dividends also harmful? Why are dividends not harmful? Is it because stock buybacks delay tax? This doesn't make sense to me. And I think ultimately you make your economy and just business as a whole less competitive, because really what stock buyback tax is, it's a surtax, because capital gains are already taxed. Now, capital gains are delayed with taxation because you don't actually sell your stocks as soon as the company buys back securities. The value of your securities just goes up. But yeah, I'm just not a fan of this. I think if you start penalizing companies for returning capital to shareholders, they're just going to find other ways to return capital to shareholders. But I don't know if this actually encourages reinvestment into the businesses. I think what it might do is, if you increase this corporate stock buybacks tax high enough, you start going to the 15 to 20%. So now you have a tax on corporate income, and then you have another tax on how they allocate that corporate income. So you've surtaxed already taxed income. You might cause companies to relocate to other countries that are more tax friendly. And so I don't know how this plays out, but I just don't think this is the right approach. And not to be outdone, in Canada, we've never met a tax that we don't like. And so, of course, Ottawa has already started to introduce a 2% tax on stock buyback starting in 2024, because, of course, they want to penalize companies for buying back their own shares for some reason. They're describing as it hurts society, and somehow I don't get it. It doesn't make sense to me, but it is what it is. Now, moving on, this is a very important comment that he made, where he's effectively saying that he's still very pro to investing in America. And so, he says, I've been investing for almost 80 years, which is more than a third of our country's lifetime. So that goes to show you how old Buffett actually is. And he goes on to say, I have yet to see a time when it's made sense to make a long-term bet against America. And I doubt very much that any reader of this letter will have a different experience in the future. And so why does this matter? Well, there's been many times in the past, and most recently would probably be around 2011, 2012, maybe a little bit earlier, maybe like 2010, where people were saying, America is done. You got to start investing in other places in the world. And, this conversation will continue to happen because, they're moving towards a debt issue ultimately. And so will that cause people to say, okay, well, now it's time to reallocate assets outside of America? Well, ultimately, I think that the country is going to have to address its spending issues. I mean, the government is spending way more than they're taking in. That national debt continues to increase. And so, that is a challenge, but ultimately there's no other place in the world that releases human ingenuity quite like the system in America. And so let's see how this plays out. But it looks to me like still the best place in the world to invest in is America. And I'm glad that Warren Buffett shares that opinion. And so in the next section of the annual report, he just starts talking about and having fun with certain things that Charlie Munger said throughout the years, and I love it. So I think Warren Buffett really gets a kick out of Charlie Munger, and it just makes me happy. And so, the first comment, I just highlighted a couple of them. And so, the first thought that he shared from Charlie Munger has made throughout the years is the world is full of foolish gamblers and they will not do as well as the patient investor. And I think we can all agree on that. I think one of the reasons why people really outperform when they manage their own securities is because they just don't stay in long enough. They go in when the market's going up and they come out when the market is going down. And so he's very much right there. And here's a good one. Charlie Munger has always really spoken like this, and so I find it very interesting. But this is a cool comment. So he says, early on, write your desired obituary and then behave accordingly. And so I think this goes back to a bigger point, which is not focusing on improvement has consequences. And so what I do every year is I actually have a whiteboard, which is like right there, and it's this huge whiteboard. It covers the whole wall. I would say it's probably like a 50-inch screen TV size, and on the whiteboard I have goals for this year, areas of improvement, and then just a list of things that I want to accomplish in 2023. And then there's a list of things that, because I've accomplished those, I can move on to these other things in 2024, 2025, 2026, and thereafter. And so the idea there is that the focus on improvement and the focus on goal setting will help you achieve massive goals. And one of the videos that I want to put out is basically like a learning session, so I might make it live, on sort of like how I set financial goals every year and how I manage to my financial goals on a bi-weekly basis or like bi-monthly basis. I'm always doing this. I'm always doing like sort of like a budget to actual and sort of like rolling it up to the 50-year goal or whatever. And so I do want to show you guys how I do that, and I think it will really help you focus more on the right things when it comes to investing. And so I will roll that out this year for sure. And he went on to cover a couple more comments. So you can learn a lot from dead people. Read of the deceased you admire and detest. So that's very interesting. Not just the people that you admire, but also the ones that you detest. I'm really not good at this. I don't feel like I'm as read as I should be. I spend so much time just looking at securities and reading the newspaper, etc. I haven't really spent some time reading about historical figures or from historical figures. So I have to do a better job of this. So this will end up on my board here, and I'll put together a list of books that I got to read. Now, there's no such thing as a 100% sure thing when investing. Thus, the use of leverage is dangerous. A string of wonderful numbers times 0 will always equal 0. Don't count on getting rich twice. And so, this is a very relevant comment, especially in light of the fact that Charlie Munger coming out and saying that, he purchased Alibaba on margin and it ended up being one of the worst investments that he's ever achieved. And what's very interesting about that is that he felt as though Alibaba was a sort of like a once in a lifetime type opportunity. So it's very interesting how relevant this comment is. And this is one of the reasons why I've always been against leverage. And I'm not smart by saying I'm against leverage. In fact, I would say the opposite is that I'm not smart enough to know when leverage is right to use. And so I just don't use it in my portfolio at all. Now let's move on. You have to keep learning if you want to become a great investor. When the world changes, you must change as well. The only thing that I would say with this comment, this is a very dangerous comment, I would say, because every time there's a surge in the market, there's a lot of euphoria, generally the market will outperform value investing. And in that time, you'll get a ton of articles that come out and say, this is the future, this is the way it's going to be. And if you are not investing in this area, you're missing out. I've seen that happen a couple of times in my life. Obviously the .com bubble, it definitely happened. And there were even articles saying that Warren Buffett has lost his touch back then. And that was when I was really young. And now, in 2020, I guess in 2020 and 2021, there was a lot of euphoria around tech companies that weren't making any profit. And so, it's very interesting how history doesn't repeat itself, but it did rhyme. And so, this was a situation where they were where they were actually comparing Cathie Wood to Warren Buffett and saying that Cathie Wood was the greatest investor of our time. And turns out that, she was just making very risky bets. She started releasing her models, and you can see how crazy some of those expectations were. And so that's a very tricky comment. And I would say, if we go back to this comment, that yes, when the world changes, you must change, but also do not forget the principles of value investing. Learn about the new companies, but look at them in line with the principles of value. Make sure that you are able to answer those 4 questions as it relates to finding great investments. Now, if you guys are not familiar with the 4 questions, I actually make them available for free. So in the description of this video, there's a link that says free stock analyzer tool. And what that is it's not really a stock analyzer tool, because there's no such thing as a stock analyzer tool that will give you an answer of whether or not you should invest in the company. And if anybody tries to sell you that, they're a liar and they're just trying to take your money. And so what that stock analyzer tool does is it just asks you to ask 4 questions, and people charge for this. I think it's crazy that people charge and make courses for this, and so I just give it away to you guys for free. And so grab that stock analyzer tool, or save the link somewhere, or download it and use it every time you think about investing in a company. If you can't concisely answer all 4 of those questions, it is not an investment that you probably should be making. Look, none of this is ever investment advice. This whole channel is focused on helping you become a better investor and, effectively learn to fish on your own. And so with that, I'll leave it there. I want to know what you guys think about the Berkshire Hathaway annual letters. Let me know in the comments below what you guys think are the most memorable quotes and comments from Berkshire Hathaway annual letters. Let me know in the comments below, and I'll highlight some of them in a subsequent video. And so I'll leave it there for you guys. And if you guys have missed any of the videos in the Q&A series, you can actually get to the whole series right here.